Exclusions can be stated in the policy itself or attached as riders. The most common types of exclusions include war. The exclusion provides that death benefits will not be paid if the insured dies as a result of war. The war exclusion prevents an insurer's financial catastrophe and typically applies to declared and underclause wars. This is typically called results clause. Aviation. This exclusion is found in older policies. Few policies issued today exclude death as a result of commercial aviation. However, some insurers will exclude aviation deaths from others for fare-paying passengers. Hazardous occupation or hobbies. Individuals who have hazardous occupations or engage in hazardous hobbies may find their life insurance policy will not pay if death was a result of their occupation or hobby. However, sometimes these risks can be covered with an increased premium charge. Commission of felony. Some contracts exclude death when it results from the insured committing a felony. Suicide. As previously noted, almost all policies exclude payment of the benefits if an insured commits suicide during the specified time period. After the period passes, death by suicide is covered. At one point in time in the insurance industry, if you did not pay your premium and failed to pay it by the end of the grace period, the policy would lapse and you would be forfeited any equality held in the policy. In response to this problem, many life insurance companies adopted the non-forfeit option. This means that you are allowed to stop paying premiums and non-forfeit any of the equality in the policy. In simple terms, you have three options on how you want to surrender your policy. The amount of cash value will be reduced by any loans that have been taken out. There are non-forfeiture options. There are three non-forfeiture options from policy owners can select. Cash surrender option. Policy owners may request an immediate cash payment of their cash value when their policies are surrendered. The amount of cash value the policy owner receives is reduced by any outstanding policy, loan, or debt. Insurers are required to make a cash surrender value available for ordinary whole life insurance after the first 3 policy years. However, most policies begin to generate cash values in as little as 1 year. Most states permit insurers to postpone payment of cash surrender value for up to 6 months. After policy owners request payment, this is stated in the delayed payment provision. Some policies require a penalty to be paid if a policy is surrendered in its early years. This surrender charge is sometimes referred to as rear end load and deducted from cash value when the policy is discontinued. The cost recovery rule states that when a life policy is surrendered for its cash value, the cost-based total premium paid is exempt from taxes. A partial surrender can allow the policy owners to withdraw the policy cash value interest-free. Most states permit insurers to postpone payment of cash surrenders for up to 6 months after policy owners request payment. This is stated in the delayed payment provisions. Reduced pay-up option. A second non-forfeitural option is to take a pay-up policy for a reduced face amount of insurance. By doing this, the policy owner does not pay any more premiums, but still retains some amount of life insurance, in essence of cash value, used as the premium for single premium whole life policy at a lesser face amount than original policy. When this option is exercised, the paid up policy is the same kind as the original, but at a lesser amount of coverage. Riders and accidental death benefits from the original policy are excluded. Once the pay-up policy has been issued, the new face value remains the same for the life of the policy, which also builds cash value. Extended term option. The third non-forfeitural option is to use the policy's cash value to purchase a level term insurance policy in an amount equal to the original policy's face value for a long period, for as long a period as the cash value will purchase. When the level term insurance expires, there is no more protection. Moreover, all supplemented benefits included with the original policy, such as term riders or accidental death or disability benefits, are dropped. For most companies, extended term is automatic non-forfeitural options for a standard insured risk. Policy dividends. As noted previously, life insurance policies may either participating or non-participating. The major difference between participating and non-participating is the presence of policy dividends. At any given age, people who buy participating par policies normally pay premiums that are slightly higher than premiums paid by those who purchase non-participating policies. This is because an extra charge to cover unexpected contingencies is built into premium for par packages. At the end of each year, the insurance company analyzes its operation. If fewer insured have died than was estimated, a divisible surplus results and the company can return to the policy owners a part of the premium paid for the participating policies. A company also can issue return stemming from positive operations or investment income. These payments are called dividends, but should not be confused with the dividend paid on stocks. Policy dividends are really a return of part of the premium payments. As such, policy dividends are generally not taxable income, unlike corporate dividends, which are reported for income tax purposes. However, policy dividends can be taxed when they exceed the cost of the policy. A whole life policy that provides a choice of dividend options must include a statement that dividends are not guaranteed. The pay up addition dividend option is popular with many policy owners. A close look at the benefits of this option will explain why. When a dividend is declared in its use in effect as the premium for a single payment whole life policy of the same type as the base policy under which the dividend is declared, the face value amount of the pay up addition is generally small, but over time the sum of these additions can be substantial. When electing the pay up additions as your dividend options, you use 100% of the dividends being paid out each year. These dividends are then used to buy additional blocks of permanent whole life insurance paid up for life. The payments of policy dividends hinge on if the company has experienced a reversible surplus for that reporting period. The size of the surplus will affect the amount of the dividend policy. Policy dividends normally vary from year to year and cannot be guaranteed. Stock companies can issue either participating policies or non-participating policies. If a stock company issues both types of policy, it is said to be doing business on a mixed plan. Mutual companies can issue only participating policies. If life insurance policies dividends are left with the insurance company, the policy may be paid up when the cash value plus accumulates dividends equal the net worth single premium for the face amount at the insured attained age. Only interest on accumulation is taxed on policy owner dividends. Dividend options. Policy owners are generally permitted by insurers to utilize their dividends through one of 5 options. Cash dividend options. When dividends become payable, they usually are paid on policy anniversary dates. Policy owners who elect to take their dividends in cash automatically receive dividend checks after the company approves a dividend. Accumulation at interest option. Another option is to leave the dividends with the company to accumulate with interest available for withdrawal at any time. Note that while policy dividends are not taxable at any interest paid on them is taxable income in the year the interest is credited to the policy, whether or not it is actually received by the policy owner. It's a good time to stop.